Shares for beginners.
Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation.
Arnold Schwarzenegger said it wasn't about his training that got him to be the champion as Mr. Universe. It was the routine before it. So every night he would make sure that his gym bag was packed, that his shoes were ready, that everything, because it wasn't the gym itself, it was getting to the gym. Because he knew once he was there, away he went and off he went. It's the same principle. Have your routine with your investing. I am contributing X amount per month, per fortnight, per year, calendar, whatever else. And my goal is to be wealthy in 5, 10, 15 years by using compound interest to my advantage.
G'day and welcome back to Shares for Beginners. I'm Phil Muscatello. What are the secret mind powers of successful investors? How does training your mind help you to protect and grow your wealth? Joining me today to share his thoughts and beliefs of the power of the meat between our ears is Evan Lucas. G'day, Evan.
Hello, Phil. That's a great lead in, the meat between our ears. The most powerful thing in your entire body, because that's right. It is just a piece of meat. What a lead in. Love it. Yeah, I try and use the term muscle because I think that's what it is. It's, like anything in your body, it can be trained, it can be worked, it can be improved, and it's inverted commas fitness is using your mind as often as you can and stimulating your mind as much as possible.
Well, I was just talking to another guest, Claude Walker from A Rich Life, and we were talking about challenging listeners. And, I was sort of saying about this podcast is, while it's called Shares for Beginners, it's not Shares for Simpletons. So I do like to go a little bit heavier than some people may want. But I think if we raise our expectations, we raise our results and outcomes.
Yeah, and I'd also look at it from a different point of view, is that even if you're a beginner, you're going to have an understanding. And what I mean by an understanding, you know how the world works, you know how the things that you do work, and you will have a very interesting and understanding about the intricacies of your own personal experiences in your life and etc. So although I agree with you, using the term beginner, all it is that you're just learning a new skill, but you've already got skills and you'll be able to apply those previous skills you've got, whatever it is, into this world as well. And I think I agree with you. I would much rather sit here, because what I think you and I are basically saying from the answers that we're both giving, which is when you look at these kinds of things, you've already got an education, and that's the term. You've already got an education. So you will, if we go too lowbrow, it'll not just bore you, but it won't actually stimulate your mind. It won't actually stimulate you to stay in this space, do what you need to do, which is, as Phil pointed out, and he does it through this entire podcast series, is, it's about building wealth. It's about also getting that skill, because that's what it is. It's just a skill to a level that you're confident enough to actually not go from just being a beginner, but understanding that investing is something that all can do relatively well. And once it's going, the confidence it gives you to let you do what you want, when you want, how you want, just, amplifies. And you're going to hear me say that term over and over in this podcast.
Good to hear. But it's also the idea that we're trying to get past the obfuscation of this industry. So much of this industry seems to be about keeping those special mind powers in the hands of a particular cult. And we're just trying to open that up and realise it's not that hard. The maths is not difficult. You don't need even calculus, There's a lot that you can do yourself.
Correct. And the other thing that I would say to those sort of magic people that you're explaining to, I've come from that world. And what I mean by that is that the way I've always been explained it and the way people always talk to me, the same thing. It's sort of like a line of continuum. There's, people on the beginner / sort of simple side. There are people on the very other side, which are this highly complex, really, really, strange modeling, all this kind of sort of inverted commas dark arts material. And I've been on both sides, and I like to think that I can now sit in the middle, and everyone can sit in the middle of those two, because Phil's right. The other thing that research shows, that history shows, is that all those models, all those, secret herbs and spices, or whatever sort of acronym or sort of pun you want to use to describe it, they don't necessarily give you above and beyond returns. And that needs to be pointed out. So in the end, what we're trying to do here is long-term. Those guys are looking short-term and trading and doing all sorts of other random little things. That isn't that isn't going to build your wealth. That isn't going to get you in a situation of being really, really happy with where your money and your overall asset position is going. It does take time. One of the things I talk about a lot now is patience. And I remember when I first started in this industry, and I know, Phil, you're the same, is, when you first get in there, the rush to move, the rush to return is really high. And human beings are geared to that. So don't beat yourself up about it. We are geared to wanting the now. Investing is a long-term thing, and you don't need to make it complex. In fact, the biggest, best examples over and over, Warren Buffett, straight out, keep it simple. He says it all the time. Ray Dalio, even he, who runs a massive hedge fund, he's like, look, the more simple it is, the better it's going to be. So that is the other part of this, is that you don't need to sit on that extreme other end that I just alluded to. Sitting in the middle will do you more than any good. It'll do you incredibly well over time.
So we've rushed into the answers and the questions, and I haven't even done your introduction properly yet. Okay, so Evan, you've been investing and researching global markets for over a decade. After getting your master's in finance, you headed to Amsterdam with ABN Amro before moving to the Royal Bank of Scotland. You returned to Australia with RBSMorgans. I just want to make sure that people understand that you do have some credentials in this area, where you developed your top-down approach. And you're also the author of the recently published Mind Over Money. So why is your mind so important in relationship with money? So
first part of that answer is, in the end, all of my experience shows, and also my background is economics, not just markets and all that kind of stuff, is that all economics is a study of you and me as a group doing things in certain directions. How we're spending, how we're not spending, what we're doing with regards to our overall confidence, not confidence, et cetera, et cetera. Then investing is the same thing. And all market is just you and I having an opinion in one way or another. And I think that needs to be put out there from the point of view that it shows that, again, if we all think that BHP is a buy, we'll all work that way and you'll push the price up. If we all think BHP is a sell, and we all work together and we'll push it down. So why I say your mind is all part of it, and where it comes into your experience is that is, these are your biggest influences. These are the things that have shaped your development. It has shaped your understanding. Now, what I mean by that is that you're going to have a particularly bad view of money if you have seen friends, family, parents, etc., struggle with money, always find themselves in debt or find themselves in hardship. Your view of money is going to be different to somebody that's grown up with it, who has done incredibly well with it from family experiences, et cetera, et cetera. So that's the unfortunate part. It's like anything. It is exactly the same as if your social scenario is high or low on that spectrum. It's all the same thing, and so you can change it. And what I mean by that is you can work it. So why your mind is so important is that you need to understand who you are. You need to understand, what is your view of money? And again, when I said this before, my view on money is this: money gives me autonomy. It just gives me the ability to do what I want, when I want, how I want. That is me. You will be different. Now, the reason I also use that quite highly is that most studies, and the best study I can show you is that there was a study that came out of Harvard around human beings and what the most number one priority human beings have. It is autonomy. Think about your work environment. Think about your overall control of your direction. You want the autonomy to do what you want. So that's the same with your investing. Your investing helps you get that autonomy. Your investing helps you move that. So I know it's a very broad brush there, Phil, but the way I answer that question is know who you are with money, know that simple is best, and understand that there is no right or wrong answer. It's the right answer for you and what you want to do. But there's many people, though, that don't even understand what needs to be done. I mean, I'm just preface this by talking about a conversation I was having with a young friend who was about 30 years old a few weeks ago. And he's incredibly disheartened. He's a tradie, he makes good money, but he feels like he's never going to be able to buy a property. And so I mentioned to him about micro investing and that you can be putting money away each fortnight or whenever you get paid. And then that money can compound over many years. And he said to me, that's the first time anyone has ever said that to me. And sometimes people just don't even know what they don't know, or don't know what they don't know. Yeah, and that's what we're talking about here. So that he has now had an experience, a relationship with you to start actually shifting his dial with his view around money. And that's what this all is. I mean, if you're listening to this podcast, you're already doing that. I mean, if you're here listening to Phil week after week, you're already trying to do what your colleague was trying to do, which is starting to understand that, look, the 8 inverted commas, it's been attributed to Einstein. We still don't know if it's true, but he's attributed with the sign of saying that the 8th wonder of the world is compound interest. If you can remember your year 10 maths, it's probably the only thing that you really need to know in terms of what's doing here, which is whenever you are micro investing, as Phil just said, or even if it's a little bit more than that, dollar cost averaging, whatever you want to use the term for doing, constantly adding to your compound interest concept and your compound interest strategy will, over time, be the best outcome that you can get. And that's not me just saying that for being, flippant. That's actually fact. The difference between your year 10 maths and the theory that I just announced and the real world is that understand markets are irrational, they're jagged, they're scary sometimes, and that's fine. And I think you need to understand that that's fine. So the way I wrote about this in my book too. I overlaid the charts. Is that the ASX, when I wrote the book, it's a little bit different now, but it's close enough. The ASX was on average on a total return, so that includes your dividends, was returning about 9.5%, give or take. If you look at that over a 10-year period with compound interest, reinvesting your dividends at that 9.5%, it gives you 155%. Now, people, when you say that number, that's not possible. So, well, actually, that's a fact. That's true. And you could do that with any sort of term deposit, okay? If you look at a term deposit, you compound interest, your term deposit, it's 4.5%. You compound everything back in, roll it immediately, blah, blah, blah. Away you go. You'll get similar numbers. It's obviously not as high as that because 4.5% versus 9.5% is different. But when you actually look at it in real life, you look at that 9.5% per annum and that 155% return over those 10 years that I did it to, which would have been at that time 2021, July 2021, when I finished writing the book, because it came out at the end of last year. Anyway, it doesn't matter. If you look at the chart together on a real basis, you can see that there's a lot of jaggedness. There's a lot of ups and downs and everything in between. You've got to have the mental fortitude / also the behavior to understand that what happens in the short term, what happens now, actually doesn't affect me. I am looking for that 10-year return. I'm looking for that 155% because, 2023 is not going to be 2033. Phil and I know that. And if you ask yourself, you know that too. I mean, look back 10 years ago and what was happening and you were doing 10 years ago to think now 10 years into the future, it's going to be that different again. We know that. I mean, we've had a pandemic in that period of time and all sorts of other things as well. All that can still happen. But over that same period of time, the market was still up 155%.
And that's just something that people need to deal with as well and be prepared for and to be educated about, is that the market does go up and down. And when you see your portfolio on the screen, and it's valued every minute of every day, it can get scary when you start seeing all that red. How would you suggest people arm themselves for this kind of experience?
Yeah, so I'm going to go back to your example you had with your friend before, the 30-year-old guy who thought he'd never buy his house. I know it's not perfect, but the analogy I always use when somebody asks me that question is that if you walked home every day and had a big neon sign above your house that had to the cent, right, how much it was worth, and that neon sign then between 10 and 4 every day moved in front of your eyes, and one day you walked home and you saw it move 10% lower, would you sell your house? I doubt it, because you know that your house is a long-term investment. You're not going to move out of it. It's the same principle. The catch is that, markets are much more what we call liquid. They're much, much more open. There's much more money flowing through them. Selling your house takes, a good 3 months in terms of what's going on. There's a lot of things to happen before you can sell your house. And that actually works in your favor to some extent, because if you were to get scared by that neon sign and you were to flick your house, you'll make a mistake. The time factor of selling it slows you down. So unfortunately, you don't have that necessarily when you're investing in markets, whether it be equities, whether it be fixed income. By fixed income, I mean things like hybrids, bonds, corporate bonds, etc. Those things are open to you to trade, and that's the right term, every day. So again, the strategy, as Phil's already slightly put out, the strategy is this. You need to find a way to look long-term. You need to find a way to not worry about the short term. Now, again, this is me, not necessarily perfect for you. I have, with my personal portfolio, not with what I do for my day-to-day life, because obviously I live and breathe markets, but for my personal portfolio, I make it very clear that I don't look at it for probably a month at a time. Now, back in the day, I would probably look at it every day, and I break that month. I mean, I'm now strong enough that if I do see a decent move in it, I don't care. But when I first started, to get over that fear, that of mistake, that also that ability to then go, oh my God, my portfolio is down 10%. I need to get out. I need to blah, blah, blah. And then clicking out, and I bet you the next day it'll take off on you. All of that thing, it's about taking the mindset away. It is then also about automating. It's, as Phil said before, micro investing, adding $100 a month or every fortnight whenever you get your thing, that then automatically gets reinvested into what you have. That is your compound interest. That's what you've got to remember. Think of it on that perspective. The capital movement up or down in today, this week, this month, this half year, this calendar year should mean nothing to you. It's about, I need to keep compounding on the idea that this is a compound interest return that I'm not going to touch for a minimum of 5 years. And if you can do that, you'll all of a sudden find that you're in a much, much better position.
You kind of referenced about how you are you, and obviously I am me. What does that concept mean? You've referred to that in the book, haven't you?
I have, yeah, and I've sort of skirted around using it with you just then, and it's been a way that I've sort of communicated whenever I've gone and done speaking events, or when I was working in my previous life, working as an analyst, or whether I was working as an advisor, and all those materials. Is the more and more I went on it, I sort of said this at the start with the answer, is that I know what I am. I know how I work with money, so I am me. And that's what I mean. What I do with money, how I think about money, how I invest my family's money, it works for me. You are you. And that gets back to this idea, is that what Phil does, how Phil invests, how he thinks, although you can probably hear, in our conversation, we're clearly very similar because we do this for a living. Phil will be different. And those of you listening, you are going to be different to the two of us as well. And that's what I mean. You are you, I am me. This is, and why I say this is also the simplest term I can say is, it's trying to get away from envy. It's trying to get away from, getting caught up in things like confirmation bias or attention bias or availability bias. Oh, that person's doing this. They look like they know what they're doing. They look like a smart person. I should do what they are doing. The catch is that they're not you. They're certainly going to have a good option. If you're following somebody reputable, they're going to have good ideas. They're going to have, but they may have, their goal might be actually to, they might be almost there. They may actually be finishing up in their investment cycle in a year, whereas you might be finishing up in 5 years, or they might actually be, highly aggressive in what they do, and they're completely fine with that, but you're not. So this is what I mean by knowing yourself, knowing you are you, knowing who you are, having an understanding that what you're doing, it may take 10 years, your friends may take 5. That is fine. Don't get caught up in them. Get caught up in you. Know your money you.
In that answer, you referred to a couple of cognitive biases. Let's just run through a couple of them. What are your favourite ones? Where have people made the most mistakes?
Oh, okay. So the three I mentioned are probably the most known. There's one other, which is called loss aversion. So I'll start with loss aversion, because the reason I say that, in the world of money, finance, economics, it's the most attributable to that world. The two men that coined it, Daniel Kahneman, who is an American psychologist who is I have a bit of an idol on him. He actually won the Nobel Prize in economics as a psychologist, coining the term loss aversion. And his study with his colleague at the time, Amos Tversky, showed very clearly that human beings are geared to loss. And what I mean by that, we are much more acute to a loss than we are to a gain. So the examples that he used, I won't go into it, but the best way to do it in a really sort of slick term is, if you put your hand into your pocket right now and you pulled out $50 that you didn't know was there, you'd get an elation. It'd probably last you at most 4 hours. If, however, you knew that $50 was there, you put your hand in there and it's gone, and no matter what you do, you can't find it, and you've lost it, you will dwell on that. And the study found to upwards of a couple of weeks. And that's the difference. Now, the other way to look at it is that it doesn't matter how big or small. So let's say you found that $50 and the elation's is a couple of hours. Even if it's $10 that you lose, you are much more likely to dwell on that. Now, why I use that example is that if you imagine that you hold an investment A and an investment B, an investment A is your good one, it goes up, $70, $80 or whatever it is, but your investment B drops by 10. Your bias will jump to the B example because you're losing, and you will much more fret on the fact that despite the fact, let's say it's $10 loss and you're $70 up, that your net 60 in your portfolio up, which is what it should be doing, you will dwell on the $10 loss, which you just, and add zeros to it, right? $10, $100, $1,000, $10,000. You are much likely to concentrate on it rather than the 70, 700, 7, blah, 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 and so on and so forth. And that is what loss aversion is. And it's a protection mechanism. Why it's a problem is that not only does it cause bad decision-making because you try and make rash decisions, the studies also show that once you're in a loss-making position, you are more likely to take rash options to try and recoup it. Chase fast returns, start using leverage, blah, blah, blah. But the other thing it can lead to, so that's the bad decision-making. The other thing it can lead to is non-decision-making, whereas the fear of loss is so high that you won't actually invest. And that is just as bad because as we came back to this whole discussion at the start of this podcast, do not forget compound interest is happening in your investment. And that's what loss aversion is. It's the most famous one, and it's the one that is most linked to that. I'll then quickly gloss over the other three for you, Phil. Confirmation bias, attention bias, and availability bias. Confirmation bias is pretty clear. I mean, everybody sort of knows what that is. If you've got a view, you basically will go and search out something that will confirm that view. And social media these days makes that very, very easy. If you've got a view that this is the thing to do, you can find that, even though it might not be. Again, the best way around confirmation bias is to make sure that A, you've automated, B, that you sleep on it is the other one, and C these days is, okay, go to social media and find your confirmation, but also find those that have the complete opposite view and ask yourself, why do they think that? In the end, if your view is the right one, then happy days, but at least challenge yourself. So that's confirmation bias. Availability bias, this is actually a challenge on the whole premise of economics. Economics and markets and market theory is we have perfect information at all points in the cycle, which is clearly not true, but that's the theory. Availability bias is actually even worse in the fact that you have such an infinitesimally small amount of information that you can act on it. So the example would be, GameStop 2021, where there wasn't a huge amount of information, but the available information that was there was that it was the right decision. All these people were doing it, therefore, bang, this is the right thing. That's your availability bias, and away you go. So availability bias and attention bias, they sort of blend into each other as well, because again, attention bias is something that catches your attention, clearly. And again, if it's everybody's doing it, away you go with it. So if you've got the available information that this is the right thing to do, the market is going up in XY%, the attention is being put on it, they almost work together. And again, the same principle is breaking it is A, sleeping on it, also challenging that view. Don't rush into acting. It's so hard. I know, and these sound really, really simplistic, but if you can give yourself 1 second, minute, hour to pause and just to challenge yourself, that, again, in the terms of what we're talking about here, long-term investing, they are infinitesimally small amounts of time that can, help you from making a bad decision or a decision that you shouldn't make.
Super is one of the most important investments you'll ever make. But how do you know if you're in the best fund for your situation? Head to lifesherpa.com.au to find out more. Life Sherpa, Australia's most affordable online financial advice.
Evan, let's create a fictional listener. They've just stumbled onto the podcast. They've listened through right to this point now, and their only experiences of the market is that they've got friends at the pub or friends that they see all the time, and they're always talking, you should buy this lithium stock, or, gold's going to run, or whatever the story is. What would you say to them to stop them making a stupid mistake?
So, what you're doing right now, if you've got to this point, you're clearly here to educate yourself. So that first and foremost is also part of the answer. The more broader knowledge and education you can get yourself, the more likely you are to be able to actually challenge, what is initially probably called the taxi driver effect, right? If the taxi driver is giving you a stock tip, ask yourself why. And again, the GameStop one is the great example. It's a real world example to show you that so many people did not stop and educate themselves to what was a very run-of-the-mill company, right? It wasn't anything special, doing something completely irrational and extraordinary in the market. So first and foremost, it's education. Whether it's going to read, whether it's going to listen, whether it's going to watch, it doesn't matter. It just gives you that little bit more confidence to challenge that view. The next one to also ask yourself is what we've just talked about. They are them, you are you. The taxi driver effect is that's the taxi driver's want. It's not my want. Yeah, it sounds exciting. Yeah, it sounds like an interesting thing, but it's not in my overall long-term goal of what I want to do. Even if you are an assertive investor, that game stock advantage or the lithium stock advantage or whatever cryptocurrency, doesn't matter. It's not in my world. And this is, again, that sort of training your mind, the fitness that comes with training your mind. Strength, inverted commas, when we talk about your mind, is strength of power of will to actually make sure you go, no, that is not for me. Yes, that is for me. And that is the fitness training of getting routines, getting it into. And again, when we say routine, I'm just sort of going a little bit further here on you, Phil, but it's like anything. Arnold Schwarzenegger is the one I use here. And why I use him is that Arnold Schwarzenegger said it wasn't about his training that got him to be the champion as Mr. Universe. It was the routine before it. So every night he would make sure that his gym bag was packed, that his shoes were ready, that everything, because it wasn't the gym itself, it was getting to the gym. Because he knew once he was there, away he went and off he went. It's the same principle. Have your routine with your investing. I am contributing X amount per month, per fortnight, per year, calendar, whatever else. And my goal is to be wealthy in 5, 10, 15 years by using compound interest to my advantage.
Have you checked out the Arnold Schwarzenegger documentary on Netflix?
Not yet. I haven't had a chance. Don't worry. I am gunning for it. I can't wait.
So good.
Because again, it's the same principle, right? He talks about this. I mean, whether you like him or not, or what he does, these are the kinds of people, and it's outside of finance, right? But his lessons apply perfectly into what we're talking about here. I mean, the way I always talk about it when I do these podcasts is that I like to run, but you can't expect to all of a sudden just go outside and run 42Ks for a marathon or 16Ks for a bit of fun. You've got to lead into it. And it will take you time. It will take you several months to get you to a fitness level that can do it. It's the same principle. So don't beat yourself up. Don't expect to go off to this podcast and go click a button and I'm gone. I've got into this mode and I'm away. It will take time. And again, that is the hardest bit, and that's where Arnold comes into it. His routine got him around the ability to make a non-decision or a bad decision, and got him into a routine that once it was there, it was automatic. Even though he's a human, he was automatically just training. And
also, I believe, just to have a sense of humour as you go about it as well, because that's so important for your mental attitude as you approach anything, whether it's markets or training for a marathon.
Correct. That's all part and parcel of it. And I think that term, just to use that straight out for Phil's term there's a level of enjoyment that you can get out of this. It might feel like a chore at the start, but once you can start getting it into your routine, your psyche, it'll go from being a chore to being something that you find pleasant to something that you enjoy. It does take time again, but it is that. And it's knowing, there's again, in the back of your head, knowing that your wealth is growing, the confidence it gives you in other things is incredible. Now that, again, I know that's a me thing, but at the same time, it's something that I hope you can see and feel over time, that you're that confidence it gives you, that understanding that through the good times and the bad, there is something there allowing me to do what I want, when I want, how I want.
Because of the name of the podcast, obviously I want to talk about shares and
which is my bread and butter.
Investing in shares.
Yeah.
Sorry, what's that?
Which is my bread and butter. It's what I grew up on. It's what I cut my teeth on. I think
that's right.
You sort of said it before. We're talking about other things, but yes, stocks are my thing.
No, that's okay. But that's this is where there's a bit of a nuance comes into it because, and again, talking about knowing yourself and that you've got to train for a marathon. My analogy is always it's like learning a language. You're not going to learn another language in a couple of weeks. You've got to spend time doing it, which is what you need to invest directly in the share market. Mm-hmm. However, you counsel about ETFs as well. So tell us about what the place is of ETFs and why you think they're suitable for some people.
I do. So what I want to caveat that answer with is that I believe you need both. So I do want to put that out there. Direct investing and ETFs, I think, are absolutely fundamental to why. And why I say that is that, again, it gets back to compound interest, but then the next thing I'm going to answer. ETFs, the advantage of ETFs is they give you a level of diversification immediately. So if you're a beginner in this and you're, again, we talked about availability bias and how and all that kind of stuff and how much information you need to make a decision. An ETF takes that decision away from you because it gives you everything immediately. It gives you CommBank, Westpac, CBA, sorry, I already said CBA, BHP. It gives you the ASX 200 straight away. Weighted, and what I mean by weighted is the size of the company to the same weighting it has on the ASX. So CBA is the biggest company by market share. It's about 9.5%. BHP is not far behind. It's about 8.5%. Sometimes it jumps above them, blah, blah, blah. The advantage of your ETF is that you just buy one thing and it gives you that same weighting, your same exposure that everybody else can get as well. And it's there. It therefore breaks that concept of, getting caught with loss aversion. It breaks the idea of trying to chase a sector or a lithium stock concept or whatever it is, because it's all inside one thing. So that's great. And it gives you a distribution, which, as I would say, again, not advice, but the way I would look at it is that I would always be trying to put the distributions, which are their dividends equivalent, to be reinvesting so that it's constantly growing for you. The other way I look at it is this: it provides a bedrock or a core or whatever label you want to put onto it. You can then allow yourself with an ETF to grow your portfolio without having to, and it's simple, without having to make huge amount of decisions. They're so incredibly cheap now, which is fantastic. You're talking less, most of them are less than 0.1 of 1% per annum. So it's fantastic. But they're not perfect. And I think at the moment, I want to point that out. Why I say that, ETFs are brilliant, as you just heard, but they're not perfect. They're not going to beat the market, which is fine because you're not there to try and chase and beat the market. But they're also they also limit your choice. They limit your longer term goals to some extent because you then have to go and chase other things. And what I mean by that, diversification. This is what I want to get to. To limit your mistakes, to limit your issues, diversification is always there. So you should have exposure to Australian shares, you should have exposure to international shares, to Australian bonds, international bonds, cash, property, etc. And that's a given strategy. That's an absolute no-known. A guy named Harry Markowitz came up with this in the modern portfolio theory, and it's been proven to work because it shows that on the upside, it will give you better than you expect, and on the downside, it will buffer you from the worst. But again, it's not going to give you, fixed income obviously is going to underperform equities as it should, but equity is going to be much, much more volatile than fixed income. Not always the case, but that's the theory. So the other part of the answer is that's why direct ownership is still there. There is still absolute opportunity to look at equities on an individual basis or to look at bonds on an individual basis. So ETFs are certainly part of it. But why I say that is, for me, I am a more assertive person. I'm still, well, at least I believe I am. I'm still young. I'm still in my 30s, although I'm getting very much towards the four handle. I know that I've got 10, 15 years. So I need to actually beat the market. I need to be getting a little bit bigger. So I've got a core, bedrock, whatever you want to call it, group of ETFs. And then I've got 20% of my portfolio that I can then look to do other things in. Whether that is alternatives, crypto, gold, XYZ, or whether that's an assertive sector, lithium, whether that's much, much higher bond chasing, developing world, it doesn't matter. And again, you can hear I'm going a bit technical here, but why I'm saying that is that this is me, and that's why I think both direct ownership and ETFs are so important. The ETF world has given people that ability immediately to create an absolute core scenario that 80% of their capital is going to be on the market return.
Sorry, I've got two questions in my head at once.
Yeah, that's all right.
It's terrible. I was going to talk about Gemma because I know we weren't going to talk about Gemma and your appearance on Your Wealth, but you gave such a good explanation of the inverted yield curve. Would you mind revisiting that for listeners here?
Yeah.
And I just want to preface this by saying that the bond markets are much, much bigger than equity markets. They're absolutely huge. They have a incredibly major impact on the prices of stocks.
Yep.
So anyway, having said that, over to you.
Okay, so in the world of bonds, and particularly in the US, the reason we talk about an inverted bond yield, so normally the curve, the longer time that an investor has to take before they get their principal back, the more...
And this is because we hear about bonds, there being 1 year, 2 year, 3 year, 10 year, 20, 30 year bonds. And that's the duration, isn't it?
Yeah. And so across that time frame that Phil just gave you is what we call the curve, right? So the 1, 2, 3, 5, 7, 10, 15, 20, 25, and 30 is what we call the curve. So the yield that you get on each of those year term bonds makes a curve. And normally the closer to time duration, so the 1 year yield should be lower than the 30 year. So it should be almost like a slight concave shape all the way out. When it inverts, as it clearly says, it means that the front end of the curve, your 1, your 2, your 3, or your 5 year, has a yield that's higher than the longer dated. So your 10, 15, 20, 30. Why that matters is that what the market is forecasting is that sometime inside the next 10 years, there will be a financial problem. So right now, we know higher interest rates, we've got high inflation across the world, not just here in Australia. Central banks are telling you that rates are going up, things are getting tight. But what the market knows is that sometime in that future, there is going to be some form of crash. There is going to be pressure. Now, at the moment, they're forecasting that in the next 2 years, the probability of a recession in the US is almost a certainty. So in the US, the market that Phil's talking about, this inverted yield curve, we compare the 2 year and 10 year, and it's always the one that's seen there. The 10 year yield, the reason we use the 10 year yield, under economic theory and under market theory, the US 10 year bond is basically seen as the most secure. In fact, it's basically unbreakable. It is the most secure product out there. There is no loss to it at all. Because the probability of the US government defaulting and not paying on your 10-year bond is next to zero. In fact, it would be zero. And therefore, it's the risk-free rate. That's the term that we use on term of it. At the moment, the 2-year bond in the US is higher on the yield than the 10-year bond. And if you go back all the way through to 1900, in the post-Second World War era, every time the 2-year bond has gone above the 10-year bond in the US, it has forecasted a recession inside the next 24 months. So that is why it matters. That is why we're all looking at it very closely. And the gap in it at the moment is the highest it's been since the 80s and the early 80s. And for those of you in the history buffs, that was back when Volcker was in power and he was moving interest rates at not just 25 basis points, so 0.25 or 1% at a time. He was moving them at 450 basis points, so 4.5% in one meeting at a time. Pretty astounding stuff on side of that. So getting back to your question in terms of what's going on there, Phil, why you look at it, why it matters so much is that the markets know, or at least are forecasting, that there is going to be an economic slowdown. But also it means that to fix the economic slowdown, the US Federal Reserve, or here in Australia, the RBA, are going to cut rates. So they know that the bond yield difference, the 2 year, so in the next 2 years, they think rates are going to be higher. But in the next 10 years, they know rates are going to have to fall because the central banks of whichever country we're looking at, here's the US, are going to cut. And that's why the 10-year is lower, because in the next 10 years, the probability that rates are going down is pretty high. In fact, I would almost guarantee that they're going to have to release it because they openly admit it. They said it. I mean, we're doing this at the moment on the 15th of June, that this morning in the US, they said that, these rates could go higher, but they're already at a tightening, very restrictive basis. And so that can't stay forever because the economy needs to move. What I'd also point out, I'm going a little bit further here, equity markets, that's so interesting about them, is that equity markets tend to actually already be moving to the positive before the recession is actually called. Again, going back to post-World War II era, history books, the market actually already knows the recession's there because don't forget, and this is pretty true, the market theory of markets are trying to price 12 months from now. 12 months from now will be very different to what 12 months is today. And that's why, although the recession might happen in 2023 or early 2024, markets are thinking basically June 2024 looks like probably even Christmas next year and touching 2025, that will be a different scenario to what we're going through right now.
Okay, well, I just wanted to finish off, and this is the other question I had going in my mind, was that I've got my own cognitive bias that I want to add to the list, and that's if you want a guarantee, go and buy a fridge at Harvey Norman. And you see too many people that they open up a position, they look at it, and it just keeps on going down and down and down. And it's almost like they feel like they can will the market to move in your own favour. But the market doesn't care about you, does it?
No, it does not. So what you're talking about there is, it's probably alluding into what we call self-attribution bias. And self-attribution is that...
Oh, I knew there'd be a name for it. Someone's already come up.
So why I say that, like, just listening to that scenario is, you are never wrong. The environment is, but when it goes right, you are right. So never wrong, always right. The market will always prove you wrong. And that's why, again, talking about your answer before about ETFs and why ETFs can remove that problem for you, because it's the whole thing moving in one direction or not, and you're okay with it. But if you've made a decision to invest in something and it goes against you, and you argue that it's not your fault, it's the market's fault, that you are willing it to go higher, that it should go higher because of, the demand for lithium in the future is going to be 4 to 5 times it is now. And we know that China is coming with all those justifications that I can give to you right now, still means you're wrong though. Right. And it still means the market is telling you that it's wrong because you invested in something that may actually have a structural problem, right? It might actually be, lithium as the underlying commodity has an interesting story, but the investment in that company is actually a problem. And why is it a problem? And you haven't done enough delving into it. But your self-attribution bias is going, no, it's the environment. It's the company or the market not realizing that, this is the company. This is the one that's going to win the lithium stock craze, or this is the one that is going to basically become the new AI future of the world, blah, 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 when it's not. And your self-attribution is getting in the way. So that's what that is. Again, there is a huge self-learning curve from this. And what I mean by that is that human beings hate being wrong. We absolutely hate it as a group of things. And you need to learn, and again, it's a lot of learning, to accept your mistakes, because being wrong in the market is absolutely fundamental 101, first thing you should learn. You are going to make a mistake. Not only that, I'd argue that your investment, even in an ETF or whatever it happens to be, you're initially going to be down because obviously you paid brokerage to get in. It's those things to think about, going, okay, I am wrong immediately and I might be wrong for 6 months. That's okay, as long as it sticks to my strategy of compound interest. But in the term of what you've done there is that I can't keep willing myself to hope the stock is wrong. It's also about accepting that, no, I am wrong, not the environment, and I need to change. I need to move away from that position because it's not fulfilling my over, because then it blends into other things like opportunity cost and a few other bits and pieces like that. That's when you start hitting those kinds of problems. And that's the way to answer that question, is that know you've got attribution bias and how to fix it.
Evan, remind us of the name of the book.
The name of the book is Mind Over Money. It was an absolute interesting, brilliant, tough, strange experience, but I'm so glad that I've done it. I'm really, really proud of it. And you can find it online on any good bookstore, Amazon, Booktopia, Dymocks have them. They're around. And I really do hope if you go and get one, you really like it, because it was a labor of love. I try and put a lot of my own self stories in there and examples. And also, I want to finish on this, is that Phil just asked about mistake. I openly tell you in that book, I've made multiple mistakes and will continue to make multiple mistakes, but I can overcome my mistakes with my long-term strategy, which is my long-term wealth. And I am well ahead in terms of where I should be. So don't get disheartened. I hope there's a few things in there you take out of it if you do buy it. It's also around your personal life as well. And what I mean by that is that experience, that link into your real world and into your money world will seep into each other, and how to deal with that in a way that can benefit both your personal life and also your money life as well. So thank you, Phil, for letting me talk about my book.
Evan, thank you very much for joining me today. It's been a real pleasure to finally talk to you.
Yes, and thank you so much for having me. It's been brilliant. Cheers, Phil.
Cheers. Thanks, mate.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.